Good evening, everyone. Welcome to Credit Spread Options for Income live workshop with John Lewis. We're glad you could join us tonight. My name's Dave Durham with Traders Reserve. We're happy to present this live workshop this evening. We're getting people in here in the door, so I'm just going to cover a few housekeeping items before we get started as people are still logging in, make sure everybody's aware of what we're doing. John, if you're ready for the first slide, we can do that.
Yeah, I'm trying. We are trying. Oh, goodness. There we go.
There we go. Here we go. So anyway, first just sound check to make sure if you can hear my voice. You can type a Y into the question box. You heard John's voice too. Great. If you want to let us know where you're from, what city you're in, where you are tonight, we're glad to welcome you. John and I are on the East Coast. I'm in outside of Washington, D.C. John up in the Vermont area where summer is yet to come, but hopefully coming. Oh, good. We got Atlanta, Florida, Texas, Jackson Hole, Wyoming. Love that. Portland, Oregon. Good area too. So anyway, we're going to get started. A few more people are logging in. While we're doing that, let me just take 2 quick minutes to go through what's going to happen here. First, this is a live workshop, but it is being recorded. You will get access to that replay. Email will be sent out to you on that. You've already been giving access to the website to get into where these recordings will be stored. You were sent an email on that, and you just sign up and register your password and information. You can get access to all the recordings there, as well as these slides from this presentation. And we will keep you updated with other things in that session as well. Secondly, use the question box here for just as you did now with the cities and the yes. You can use that to ask questions tonight. We will be taking questions at the end of the presentation. John's session should run about 90 minutes, and then we'll take all of your questions. If you could just save them till the end, that'd be great. If you want to take notes, I think that'd be a good thing to do. John's going to have a lot of good material to go over here. Both, I think it'll spark your interest and ideas as well as your questions. And if you can save those questions till the end, we can get to them all. Just a quick next slide, John, looking ahead to the way these roll is we're 7:30 tonight, and then tomorrow we're back here at 12 noon. John will go into that in a little more detail as well. You'll be sent a reminder email so you know when to get back in. We'll always do that for any of these sessions. And then again, we get together Friday for our 30-minute trade session. Again, John's going to highlight that. That's at 3 p.m. on Friday, 3 p.m. Eastern time. Lastly, if you have any problems with accessing the recordings or getting into anything, please use our customer care team. It's Mike and Leslie. You can reach them at support@tradersreserve.com or 866-257-3008. They'll be glad to help you with any technical problems in terms of getting access to the material, getting into the sessions, and going from there. So we're about ready to get started. We got the last few people coming in. Let me just go ahead and start by introducing John. John Lewis. John and I have known each other for a long time. I think I'm very happy John can be putting this program together. He's an option trading expert, but more important for me, he's a great teacher and a great educator. I think in the options area, whether you're buying or selling options, in this case, we're talking about selling credit spreads. He has over 20 years experience in this marketplace in trading in both writing and publishing and editing. He's with Schaefer's Research previously. And I really like it because his passion is training and creating education products for you, the option trader, and helping you come along and learn as well as to benefit from that in the trading process. John's also an active distributor and author for places like Bloomberg, AfterTrader, CNBC, Traders Journal, and Stock Futures. And again, he's mentioned a number of different financial guys. I've worked with John, like working with him again, and it's been a real pleasure to bring him back here. So, John, without further ado, you're on.
Excellent. Thanks, Dave, for that intro. Appreciate it. Glad everybody is here. Welcome. If my screen will behave and advance, I'd be happy. Okay. Well, that's not good. There we go. Okay. Sorry about that. A little technical stuff. Thanks again. Welcome. Glad everybody's here. Just want to go quickly over what we have on tap this week. Dave mentioned it briefly, but today we're going to go over the whats and the whys and the hows of credit spreads, basically give you the bones of what the trade is all about. Tomorrow then at noon Eastern time, we're going to do a live trading session. I'll go through a trading checklist to begin the hour, and then I'll have some trade setups ready for you, and hopefully we'll get a couple of trades on around the noon hour tomorrow. And then on Friday, we'll review those trades, see where they stand, and then hopefully get into what I call a 30-minute trade, which is not a last-minute trade, but maybe a last-hour trade on Friday, trades that expire in literally less than an hour. Sometimes we get in, sometimes we don't, but at least you'll see the process that I go through to try to find these trades and hopefully learn something about how to get into them, and hopefully we can make some money on Friday. So I'm having problems moving, but okay. It may be a little bulky trying to move, so bear with me. Tonight, we're going to go over a few things. I've got a lot of things on tap for tonight. We're going to go over credit spread basics. We'll put together credit spread trades so that you can see how the trade is put together, how it works. We'll go through some sample trades. Have a list of a few things to consider before you start trading, things to keep in mind while you're trading. Then go through a trading checklist, basically the process that I go through to put on the trade, and then questions at the end. So save your questions, have them ready, and Dave will fire them at me. So in putting this presentation together, I made a few assumptions that the audience and that you all do have a basic knowledge of options. You know what calls and puts are, you know what expiration dates are, you know about assignment, you know about strike prices, things like that. So this is not an Options 101 course. This is more of an intermediate program designed for people who have experience trading options. They know that options are an important part of your portfolio, and they have many uses. They can be used for speculation or income or protection. So there's many uses for options, and maybe you've experienced some of those. You may have started out like I did, buying options, discovered the joys and the pains of buying options. Perhaps you sold a covered call or a naked put, so you've been on the buying side, maybe on the selling side, and now it's time to take the next step, where we put these strategies together in the form of a spread where we both buy and sell calls or puts. And a spread is basically selling one option and buying another option simultaneously on the same underlying security. And by buying and selling in the same transaction, we're reducing the trade's overall risk. So we're defining the risk of the trade in a spread. Now, spreads have many forms. They come in many varieties and colors. There's calendar spreads and back spreads and ratio, credit, and debit. These involve different months, different strike prices, same strike prices, different months. There's all sorts of iterations of spreads, and as you become more advanced with spreads, they can involve more than 2 options. Some involve odd numbers of options. Some involve 4 options, 6 options, all sorts of combinations, and as they get more advanced, the names tend to become more colorful, where you get butterflies and condors and iron condors and straddles and strangles. So there's all sorts of spreads out there, but we're going to focus today just on the credit spread. Now, spread trading, if you've never done it, is a different type of animal. Because you're buying and selling options on the same equity, you're essentially taking both sides of the trade. And in doing so, you're reducing your risk. You're defining your risk up front. And how that works is you're taking directional risk mostly out of the mix. It's not entirely out of the mix. There is a directional bias with credit spreads, but it's not nearly as pronounced as with straight buying of option premium. And with credit spreads, you're letting time decay work in your favor because you are essentially selling the spread. So you're a net seller of premium, and you're letting time decay work in your favor. And this is something I'll talk about in a bit. And one of the real benefits of credit spreads, and something that I'll also talk about later, is that you can be somewhat imprecise in your analysis of the underlying stock. It can move somewhat against your anticipated direction, and you can still enjoy the maximum profit for the trade. Now, along with this lower defined risk, there is a cost, and as you would expect with risk and reward, if you have lower risk, you're going to have lower reward. So while risk is reduced, the profit potential is as well, and the reward for a credit spread is the credit that you receive up front. You can't get any more than that. That's the best you can do in the trade, is to retain the credit that you received up front. Now, the credit spread trading and how I like to do it, I like to look at it as the tortoise and the hare approach. And the hare approach is more of the buying premium, where people are looking for the big hits. They're looking for the 3 and 4 baggers, the 200-300% trades. I've done them. They're thrilling to do, but the problem with that is you find out that they're rather rare. And you're looking for the big hit. You're looking to swing for the fences, and there's a place for that. Buying puts and calls, and I'm assuming that most of you have gone through that. And the rewards can be huge, but they are certainly less frequent than you would like to see, because you have to fight a number of headwinds, whether it's the stock moving in the right direction right out of the gate, or depending on the magnitude of the move, the timing of the move. There's a lot of things that have to happen for you that have to happen in your favor in order for that trade to be successful. Credit spreads is more of a tortoise approach, however, because we're looking at a situation where the winning percentage is much higher. The average return that we get per trade is lower. So we're sort of reversing the premium buying paradigm of big hit returns, low frequency, to lower returns and a higher frequency. And as they say, slow and steady wins the race, and that's something I believe in. It's nice to have a nice steady stream of income, and that's what credit spreads provide. Bear with me on the moving the slides. For whatever reason it's stuck. Let's go to a credit spread now. What is a credit spread? A credit spread is a vertical spread. By that I mean you're buying and selling options that expire at the same time. So you're buying and selling either puts or calls with the same expiration date on the same underlying equity. And with a credit spread, obviously, as the name implies, you're receiving a cash inflow. And the reason that you're getting a cash inflow is that the income that you get from the option that you sell is greater than the premium that you're paying for the option you're buying. So if more cash is coming in than going out, there is a net credit to you at the open of the trade, and that's why it's called a credit spread. So you receive that money up front, and that's the best that you can do on that spreads. I like to trade out of the money options. And what do I mean by out of the money options? I'm sure most of you know the concepts of out of the money and in the money, so I'll go over them quickly here. Call is out of the money when the strike price of that call is above the equity's market price. So if the call strike is above the equity's price, the call gives you no advantage. There is no inherent advantage in using that call or in exercising that call, because the strike price, you'd have to pay more than the market price for that equity. So if the call does not confer any advantage to you, it's considered out of the money, and that's when the strike price is above the equity price. In contrast, a put is out of the money when the strike price is below the equity's price. So a put with a strike below the market price is something that does not give you any advantage. Why would you sell shares at a price lower using the strike price than you could get in the market? So a put is out of the money when the strike price is below the equity price. Now, Out-of-the-money options. What is it about out-of-the-money options that we like? First of all, out-of-the-money options have no intrinsic value. They give no advantage to the holder of the options. There is no intrinsic value, but of course there is a premium attached to them, and that premium consists entirely of time value. So why do we use out-of-the-money options? Well, the first reason is we want to avoid being assigned. An assignment is much more likely if an option is in the money than if it is out of the money, and we're reducing that risk. If an option's out of the money, there is no advantage to the holder, therefore it's not a smart idea for them to exercise these options, and if these sold options remain out of the money, there's no threat of being assigned, the options expire worthless, and we get to keep the credit from the trade. The other thing about out-of-the-money options is the concept of time decay, which, as anyone who's bought options knows, is something that can be a real pain in the neck. But if you're a seller of premium, if you're a net seller like we are with credit spreads, time decay is your friend. All options suffer from a reduction in their value and a reduction in their time value due to time decay, such that the value of that option is zero at expiration. So an option premium an out-of-the-money option consists only of time value. That time value will eventually fall to zero, and if that option remains out of the money, then its value is zero at expiration. It expires worthless, and you don't have to do anything to it to close your trade. In the money options, on the other hand, they have to be either closed out or they'll be automatically assigned. So that's something we do not want to deal with as option sellers. Out-of-the-money options have a better chance of expiring worthless compared to in-the-money options, and that's something that's the goal of our trade, is to have these spread expire out of the money. And when looking at how far out to go, we prefer, or I like to use options that expire in about 2 to 8 weeks. And 2 to 8 weeks seems to be what I call a sweet spot, where the rate of time decay is sufficient and there's enough time value in the option to decay. So you might say, well, I like real short-term trades. Well, short-term trades are great because they're safer. You're not giving the stock that much time to move so that your sold option could move into the money. But on the other hand, you're not going to have much time value either. So there is a place for short-term trade, which is something we'll try to look for on Friday. But generally speaking, options that expire with 2 to 8 weeks until 2 to 8 weeks left, life left in them, are the ones that really seem to have that nice balance of time decay and time value. The goal of credit spread, which I've said previously, and I'll say many, many times again, is both options remaining out of the money through expiration. They both expire worthless. And one of the benefits is that you retain the entire premium, the entire credit that you received up front, without incurring any extra commission costs. So unlike buying premium, in order to take your profit, you have to sell the option or assign it or exercise it. In this case, with credit spreads, if the options expire worthless, you do nothing. You get you keep your premium, and you move on to the next trade without incurring another commission cost, which, as I'll discuss later, can be rather significant when compared to the credit that you receive. So now what I want to do is go into a couple of examples of how to put credit spreads together. We'll start off with a bullish credit spread using puts, and then I'll move on to the bearish spread, which uses calls. And you may think, well, if I'm bullish, why am I using puts? If I'm bearish, why am I using calls? Well, keep in mind that you're a net seller of premium. So when using out-of-the-money puts, the way that an out-of-the-money put stays out of the money is for the stock to stay flat or to move higher. So that is our ultimate goal, is for that option to remain out of the money. Therefore, we use puts that are out of the money, which take advantage of that bullish move, or a flat move for that matter. So we're using puts if the underlying is flat or moving higher, out of the money puts, as I've said before. And we're buying the put that is further out of the money, so it has a lower strike price. And we're selling the put with a strike price that's closer to the stock price, so it's not quite as far out of the money. In doing so, we're bringing in more premium with the sold put than we are with the put that's further out of the money, so we collect a net credit. when opening the trade. So let's look at an example. Here I have we did this trade in mid-February, February 19th, when Nike was trading around 59.31. And the expectation at that point was that the stock would remain above the $55 level over the next month. The 55 is there in the blue line, the horizontal blue line. One other thing about Nike at the time is its volatility was elevated, and that's good for options traders. That's something I'll discuss later as well. Good for sellers of premium because we were able to collect a higher credit. So in putting on the bull put spread, we sold the March 55 put for 72 cents, and we bought the further out of the money 52.5 put for 38 cents. So the net credit to us was 34 cents or $34 per contract. Remember, one option contract covers 100 shares. And I did 10 spreads or 20 contracts total. So we multiply 34 cents times 100 times 10 to get $340 as the credit on this trade. Now looking at that sold 55 put, it expired in 28 days. It expired the regular monthly cycle for Nike options in March, so it expired on March 18th. That was a 28-day lifespan for this trade. And that sold 55 put was 4.31 points out of the money. That represents a move of over 7%. So Nike would have had to drop more than 7% in that 4-week period in order for this trade to start to lose value. And the probability of that happening at the time we put the trade on was about 24%, so about 1 in 4 chance of that happening. And remember that our goal is for that short 55 put to expire worthless, so we needed Nike to stay above the 55 level at expiration. And again, I've already said that there was a lot of cushion here, a lot of wiggle room. We had a 7.3% cushion, so the stock could have moved more than 7 points against our expectations, and we could still keep all of the premium that we received at the beginning of the trade. So that's quite a cushion that we had, quite an amount that we could be wrong and still have a maximum result for this trade. Now, one of the things about credit spread is there is a margin requirement, and I know that people get a little antsy when they hear the word margin. Really, this is a different kind of margin, and margin probably isn't even the proper term for it, but that's what's used, although some broker platforms don't even use margin. They use buying power effect. That's one thing on Thinkorswim that you'll see, buying power effect. They don't call it margin. So the margin requirement for a credit spread basically covers the worst case scenario. And the worst case scenario is for the stock to move such that the purchased option, in this case the 52.5 put, moves into the money. So Nike would have had to move all the way down to 52.5 for this to happen. So in calculating margin, you take the width of the spread, which in this case was 2.5 points, minus the amount of the credit collected. So we had a 2.5 point spread. We collected 34 cents in credit. So our margin is $2.16, and we multiply that by 100 and then by 10 to get $2,160 for the margin required for this trade. And again, that is the maximum loss that could occur from this trade. We can calculate the return on the trade by dividing the credit received, in this case $340, by the margin of $21.60, and that gives us a return of 15.7%. And keep in mind that that's achieved in 4 weeks, so that's a pretty nice return for a trade open for about a month. As the downside of the trade, just want to reiterate, make sure you're aware of what the downside is. The downside, the maximum amount that you can lose, is also the margin for the trade. So that would be the maximum downside. It would be $250 per spread pair, which is the width of the difference between the two strike prices, minus the premium that we collected. So it would be $216 per spread pair. and that happens only when the stock drops below the strike price of the purchase put, which in this case was 52.5. But as I said before, the stock would have to move quite a ways in order to get to that maximum loss point. In this case, it would have to move about 11.5% or 6.8 points lower within 4 weeks to hit that maximum loss point. And the probability of that happening is pretty low, which is why the win rate for these kinds of trades is high, even though we're getting much less return, in this case 15.7%. One other thing about the trade to look at is the break-even point. At what stock price at expiration will this trade break even? Well, for bullish spreads using puts, break even is you take the strike price of the sold put, which in this case is 55, and you subtract the credit that you received, or 34 cents. So the break-even point is $54.66, $54.66 is the break-even point, and that represents a move of about 7.8%. So the stock would have to move 7.8% in order for this trade to begin to enter losing territory. At that point, at the break-even point, the sold put is in the money by the same amount as the credit that you received, or 34 cents in this case. So the liability for that short option, as the seller of that option, you have a liability of 34 cents, which is offset by the credit that you received of 34 cents. So how did the trade turn out? Well, you can see right there that Nike behaved rather well and never was in danger of moving below 55. In fact, it never closed below 58. Closed around 63 on March 18th. So the spread easily expired worthless. We got to keep the entire credit of $340. We got our margin back. And as a little added bonus, we didn't have to incur any trading cost to exit the trade. So a good trade on Nike. Now let's look at the other side, where we look at bearish credit spreads using calls. Remember, we use calls when we are neutral to bearish on the underlying stock. We're using out-of-the-money calls. In this case, we're buying the call with a higher strike because it's further out of the money, and we're selling a call with a strike price that's lower strike price that's closer to the market price of the underlying stock. Collect a net credit when opening the trade. And in this case, we did a bearish spread on Yahoo. We put this trade on at the end of January 29th. At the time, Yahoo was treading water around the 30 level. The 50-day moving average was overhead, downtrending. I was looking at that as a possible resistance level. So we had a nice setup here for a bearish spread. So what were the particulars of this trade? Well, we opened a February 33 call. We sold the February 33 call for 32 cents. We bought the 34 call, so the further out of the money call, for 18 cents, giving us a net credit of 14 cents or $100 for 10 spreads, which involves 20 contracts. Looking at that sold 33 call, this trade was only open for 3 weeks, 21 days, expired on February 19th. The 33 call was 3.5 points, or about 11.8% out of the money, and the probability of that option moving into the money at expiration was only 15%. Another thing that I liked was the 50-day moving average was between the stock price. Remember, the stock price was around $29.50, and the sold strike of 33, so that 50-day moving average was around the 32.5 level, ready to provide some potential resistance. And again, our goal is for the short 33 call to expire worthless, so we're looking for Yahoo to stay below that 33 level over the next 3 weeks. And just to show you here graphically how far Yahoo had to move against our expectation in order for that sold 33 call to move into the money. So we had an 11.8% cushion. If Yahoo did not move that far, we get to keep all of that $14 premium, or $140 for 10 contracts. And you can see there the trade duration of 3 weeks. Looking quickly at margin and return, the margin in this case was 86 cents because this is a 1-point spread, the 33 and the 34 strikes. So we had a 1-point spread, and we collected 14 cents in credit. So we subtract 14 cents from 1 point, so we get 86 cents or $860 for 10 contracts. Remember that our credit was $140, so our return, 140 divided by 860, is 16.3% on a trade open for just 3 weeks. Looking at the downside, the margin of $86, that's the maximum loss for the trade, dollar minus 14 credit, or 86 cents, or 860, that's your margin. And that will only happen if the stock goes all the way up to 34 from 29.5, and that represented a move of more than 15%. And keep in mind that you have defined your risk. This is one of the things about these trades. You've defined your risk. That is the maximum that you can lose on this trade, because above 34, the gain that you're getting from the 34 call exactly offsets the loss that you're incurring from the short 33 call. So the loss cannot increase no matter how high Yahoo goes past 34. The break-even point for this trade when you're using calls for a bear spread is the sold strike price plus the credit that you receive. So the sold strike was 33. We got 14-cent credit. So at a price of 33.14, that 33 call is 14 cents in the money, but we received 14 cents in credit. So that is our break-even point. And that represents more than 12% of move in the wrong direction in that 3-week period in order to hit that break-even point. And certainly the odds against such a large move happening are rather high, which is why we have a higher win rate with these trades. So let's look at the results for the Yahoo trade. In this case, Yahoo actually moved a little bit against our expectations. Note that it moved down quite a bit after we put the trade on, but then it rallied a little bit and actually closed at expiration on February 19th about 50 cents above where we got in to the trade. So actually, we were a little wrong on direction at expiration by 50 cents. Nevertheless, the spread finished well out of the money. Yahoo only closed around 30. We were at 33. Wasn't even close to finishing in the money. Spread expired worthless. We get to keep the entire $140. And again, no commission cost to exit the trade. I have a profit and loss chart here for this trade, which illustrates all these components of the trade that I'm trying to point out to you. Note that the trade achieves its maximum return of $14 or $140 for the 10 contracts over a wide range of outcomes. So Yahoo could have gone down as we expected. It could have stayed flat. It could have gone up a little bit, which in fact it did. It could have even gone up quite a bit more, all the way up to 33. So a wide range of outcomes would have resulted in a maximum profit for this trade. Only when the stock goes above 33 does the trade start to lose value. At 33.14, there's your break even. Any price above 33.14 at expiration and the trade enters losing territory, and that loss expands until you get to 34, at which point you've reached your maximum loss of $86. Any price above that, and the loss does not increase. And again, there's a move required of more than 12% to turn this trade into a loss. So more than 12% move in the wrong direction in order to move above that break-even point at 33.14. So now I want to go into just a couple of features of credit spreads, advantages that really I've sort of sprinkled throughout the discussion so far, but just want to reiterate them here quickly. Advantage of credit spreads is, number one, that the trade will achieve its maximum return, which is keeping that entire credit over a wide range of outcomes. So we had two examples here where Nike could have moved more than 7% against us, Yahoo could have moved nearly 12% against us, and we would still have a maximum outcome because our sold options remained out of the money. We were able to trade options that were well out of the money and got a sufficient credit for them, and there was plenty of wiggle room, there was plenty of cushion in those trades to allow those options to expire worthless. So the beauty of credit spreads is that you can really be wrong about direction. Your analysis of the underlying stock can be flawed, it can be wrong, and we're all wrong at times, some of us more than others, and you can still be very successful. In fact, the stock doesn't have to move at all. A flat stock is beautiful. I love stocks that are flat because I know that that's going to be a winning trade every time. And there aren't too many strategies that you can say that about, that you're making money if the stock stays flat or if the stock actually moves against you, in this case by some pretty appreciable amounts in a short period of time. Another advantage is that you don't have any extra commission costs incurred if you have a maximum trade. So if the options expire worthless, you don't have to do anything. Options just expire, and you get to retain the credit, and you move on to the next trade. This will increase your net profit, and something I'll talk about later is the impact that trading costs, trading fees can have on your overall return. They can be rather significant. Just think for the Yahoo trade, we were talking about $140. Just think about, say, $20, $25 to get into that trade. What if you had to get out of it? That's $50 of your $140 eaten up in commission. So it's nice not to have to pay that commission to get out of a winning trade. And the third thing, and this is sort of a restatement of advantage number one, but I want to reiterate that you don't need the stock to move in your direction. Unlike buying premium where you need direction, you need speed of movement, you need magnitude of movement, you need none of those really for a credit spread. Because the key for a credit spread is not for the stock to move wildly in your favor. That's fine. If it does, you'll have a winning trade. But it doesn't have to. It's not a necessity to have a winning trade. The important point is for your sold option to stay out of the money. So direction, speed of movement are not that important, and you really don't gain any extra benefit or extra return if the stock moves as you expected it to move. So in the case of Yahoo could have dropped to $25, it could have dropped to $20. Doesn't matter. The best I can do on that trade is get that $140. But you can be hurt if the stock moves significantly against you. So what you're trying to do is prevent the stock from reaching that sold strike price rather than getting the stock to move toward some price that you expect, in the direction that you expect. And that's quite a different setup than for buying premium. This is something I'll talk about a little bit later as well. Now all this is something that I like to call the art of trading spreads. And it's why I enjoy spreads so much and really have a lot of fun trading them. There are so many components and there's so many facets to a credit spread trade that it allows you to adjust a lot of different components to change the risk-reward dynamic of the trade to fit your particular trading style, your particular risk temperament, just your comfort level. And you're allowed to manipulate a number of factors such as the gap between the two strike prices, so the width of the spread. The wider the spread, the more credit you'll receive, but also the higher the risk. You're going to need more margin for wider spread trades because the width of the spread is wider, and that's a major component of the margin that you have to put up. Also, your choice of the underlying stock, the time until expiration, how far out of the money the sold option is. These all contribute to your risk and reward, and you get to, after you do these for a while, you get to a point where you feel comfortable. You say, I really like trading spreads that are, maybe a month and a half out, or I like trading weekly options. I like trading spreads that expire in 2-3 days. Some people like to trade spreads that are closer to the money than others. There's a number of things that you can do once you get used to how the process works and how the trades work to manipulate. So it's an art more than it is a science, which makes it a lot of fun. Now I want to go over a few factors to consider when looking at these kinds of trades. First is margin and return. I said I'd return to margin, and no pun there, but we'll talk about margin a little more in depth because I want to make sure that people understand what it is and how it's used. I also want to talk about probability of in the money, something that I talked about briefly in the two trade examples, and also assignment risk and an expiration risk. So let's move on, and I guess it's still going to be a problem. The first thing is margin. And the thing I want you to take home on margin is don't fear margin. Margin is not an evil word. It's not a scary word. Margin is just there to cover the worst case scenario. And because it's there to cover the worst case, margin can increase, so there isn't going to be margin calls. You're not going to have sleepless nights because, like with short selling, your margin could go up. It's not going to increase. You can use margin in a retirement account. You should check with your broker first, but I'm not aware of any brokers that don't allow credit spread trading in a retirement account. So it's not a problem. It's not the same margin as with short selling. Like I said before, some trading platforms don't even call it margin. Thinkorswim calls it buying power effect. Again, to calculate margin for a credit spread, it's a very simple calculation. You just take the width of your spread or the difference between the two strike prices and you subtract the credit received. So if we have a stock at 42 and we're trading a bullish spread using the 40 strike put, which we sell, and the 35 strike put, which we buy, we sell for $1.50, we buy for 75 cents. Our net credit is 75 cents or $75 for the spread pair, and the width of the spread is 5 points. Our margin in this case is the width of the spread minus the credit received, or $5 minus 75 cents. So the margin is $4.25 times $100 times 100 for the number of shares per contract, or $425 per spread pair. Now that's for one pair. If you do two pairs, the margin just doubles. 3 pairs it triples, so it goes up to $8.50, $12.75, and so on. Margin is your friend. Margin is not something to be scared of. Again, just want to reiterate, it covers the worst case situation. Won't increase. You've already put up the worst that the trade can do to you. So it's not going to go up. No margin calls from your broker. Looking at return, we use margin to figure your return on a credit spread because margin is the amount that you have to put up as the initial investment, and the income that you receive is the credit that you retain. Now I'm saying retained credit because the ultimate return on the trade is the credit that you are left with at the end of the trade, not necessarily the credit that you get at the beginning. If you have to buy back the spread because the stock is moving against you, that credit will go down, so you actually need to look at the net credit at the end of the trade to see what the return was on the trade. If the trade expires worthless, then the initial credit is the same as the retained credit because you get to keep all of the premium. Close the trade early, then you just have to take the net credit or loss in whichever case it is and divide it by the margin. So looking at that example using that $42 stock, our maximum return is the credit that we received initially, or $75, divided by the margin of $4.25, and that gives us a return of 17.6%. And again, that's the highest return that you can get on this trade because the credit will not go up. Margin will not change either, so 75 divided by 425, 17.6%, best you can do. Now let's say the stock moves against you and you end up buying the spread back for 40 cents. So you incurred a debit of 40 cents to close the trade. Well, remember that you collected 35 cents initially. I'm sorry, 75 cents initially. So that gives you a net credit of 35 cents, 75 minus 40. So 35 cents or $35 per spread pair. So your net return in this case would be 35 divided by the margin of 425, or 8.2%. Now let's say you buy the spread back for $1. The stock really moves against you. In this case, you're buying the spread back for more than you received up front. So you have a net loss. In this case, you take the $1 and subtract it from the credit, so you get a net loss of $25. If your return is negative 25, you divide that by 425, and your net return is a minus 5.9%. And the maximum loss is 425, so the return in that case would be minus 100%. So you're always using that initial margin to calculate return, and then just using the net credit that you get at the end of the trade and divide it by that margin. Now, one more thing I want to point out about credit spread margin is that it's less burdensome than other stock and option strategies. So, for instance, if you're looking at to short sell that $42 stock, you'd have to put up $4,200 times 50% to give you $2,100 on a margin account. If you want to play a covered call, you'd have to buy the shares for $4,200 or $2,100 in a margin account. So you need to put up at least $2,100 for a covered call. If you did a short put, the margin in that case is $640. I won't go into the derivation of that here. And compare that with our credit spread, which only required a margin of $425. Now, what that gives you is a lot of flexibility, and it's very amenable to smaller account sizes. So one of the benefits of credit spreads is that you're able to trade with smaller accounts because the margin requirement is much less than with other option strategies. Now, I want to move on to probability of in the money. And what that means is the probability of an option, in this case we're looking at the sold option in our spread, expiring with intrinsic value, so expiring in the money. At any price that it's in the money, doesn't matter, what is the probability of that option being in the money at expiration? And if you take 1 minus the probability of in the money, that would be the probability of that option expiring out of the money, and that is also the probability of your trade achieving maximum success. So if the trade finishes out of the money, you get to keep all of the premium that you received up front, all of that credit, and that is the maximum profit that you can get for that trade. So the probability of the option finishing out of the money also defines the probability of your trade achieving maximum success. You can also estimate the risk of the trade, the risk of that trade starting to lose money. That would be the probability of that option finishing in the money. And what I try to do when I'm looking at what option I want to sell, I shoot for at least 30% or less probability that that option is going to finish in the money. In reality, I'm really looking at probably 20% or less, but I will look at options that are 20 to 30% probability of in the money, especially if I'm looking at shorter time horizons. But generally speaking, I like 20% or less, but I will look at 30%. Anything above 30%, and I really don't want to look at that. That just is above my comfort level. You may be different. You'll find a level that you'll be comfortable with. For me, it's 30%. Now, one thing that you'll see on some websites is something called probability of success or probability of profit. And that is not the same as probability of in the money or probability of maximum success. Probability of success or profit is simply the probability that that trade is going to return at least 1 penny of profit. So in order for that to happen, the sold option would be in the money. In order for that it would be just above the break-even point in order for that trade to return a penny or more. I'm not really interested in a trade returning a penny. I'm not interested in a small profit. I'm interested in the maximum success probability. So I don't use probability of success or profit. You'll see these on websites. Make sure you look and see what the definition of those terms are. Probably you're looking at the probability of a trade finishing with at least a 1 penny profit, and that to me is a useless statistic. So focus more on probability of in the money rather than probability of success or probability of profit. Now I want to move on to assignment risk, and this is something that people who sell options are all too familiar with. Assignment is basically having to buy or sell the underlying stock because the holder of your put or call has decided to exercise their option, and you are obligated to follow the terms of that contract by either buying or selling the shares for the strike price of that option. The thing you have to realize about assignment is it's going to happen to you eventually. If you're selling options, assignment will happen, and you're going to have to deal with it. Should you be concerned? Well, it's something to be aware of, but that's why we're using out-of-the-money options. So you can control the assignment risk by getting out of a trade if your sold option is moving in a direction that's going to put it in the money in a short amount of time. If it's nearly in the money or in the money, you may want to think about closing the trade. But keep in mind that one of the things working in your favor as a option seller is that the probability of somebody selling of exercising an option is rather small if there's appreciable time value left in that option. Because what happens when you exercise is you're really only gaining the intrinsic value, the advantage that that option gives you over the market. That's the only thing that you're recovering, and you're losing the time value of that option. So rather than exercising the option, you're probably better off just selling it in the market. And if somebody sells it, that doesn't affect you as a seller of the option. Your credit spread is okay. So understand that assignment will happen, but as long as your option has some appreciable time value left in it, you should be okay. The other thing that you need to be aware of is expiration risk. And what this is the risk of your sold option expiring in the money. So it will be automatically assigned. This is something that you do not want to happen. You want to avoid assignment at all costs at expiration. And the reason is you don't have undefined risk at that point. Remember that one of the benefits of spread trading is that you are defining your risk. You know your risk up front. It's that margin amount, and you know what it is up front, and you're aware of it, and you're constructing the trade such that the reward and the risk and the probability of achieving maximum success all are working in your favor. Once the spread expires, all that's off the table. There is no more protection. Your purchased option is no longer there to protect you, so you now are at risk of that stock, which you have to either buy or sell, moving drastically against you on Monday or whenever the next trading day. So you're opening yourself up to a potentially large loss on that next trading day, which is something you want to avoid. So my strong advice is to close out, buy back in the money options before they expire. Don't go through the process of automatic assignment because you're really opening yourself up to the unknown, and that's something we want to avoid with spread trading. Okay, now I want to move on to my credit spread trading list. And this is the process by which I go through choosing all of the parameters for my credit spread trade. So I'm choosing the stock, I'm choosing the strike prices I want to use, the timed expiration, how big my position is going to be, in other words, how many contract pairs do I want to sell, and also my trading costs. So there's a number of things that we go through in this trading checklist. Remember that the overall goal of our trade is we want to sell high premium and buy low premium, or better yet, I like to say sell high and buy no. So we're selling rich option premium if we can find it, and we're allowing that premium to expire worthless so we don't have to buy it back. So in choosing the proper stock, what are the things I look at? Well, the first thing is too obvious to even mention, but I'm going to mention anyway. Make sure it's optionable. Really, that's not much of an issue. Most every stock that you really care about is optionable. So we can move on. The next thing is stock liquidity. Generally, I'm looking for stocks which trade over 1 million shares a day. Again, that's really not much of a problem. The reason I like higher volume is that usually lends itself to higher option volume, which is good for bid-ask spreads. It's good for spread trading. The other thing about more daily volume is that it lends itself to more accurate in the money and out of the money probability calculations, which is something that I'm relying on. So that, remember that 30% level I talked about the percent in the money? Those calculations, which are available on any broker's platform, rely or are more reliable. They're statistically based numbers, and they're more reliable when you have higher levels of trading. The other thing I want to be aware of with my stock is any upcoming events, whether those be earnings, which is pretty obvious, but there could be other things like product releases. If there's going to be some sort of legal ruling that involves the company, if it's a drug company, perhaps it could be the result of a drug trial or a ruling from the FDA. There's all sorts of things that could happen that could affect the price of your stock. So try to be aware of all those events that could occur during the lifetime of your spread. As far as option characteristics of a stock, you look at the option volume and the open interest. Option volume is simply the number of option contracts traded within a given day. Open interest is the number of contracts in effect at the end of a trading day. Generally, in terms of open interest, I'm looking for at least 1,000 contracts in open interest within a given series, whether it's a monthly series or a weekly series. I like to see at least 1,000 contracts, and I also like to see at least 100 contracts in volume for any one strike price within that series. So those are a couple of guidelines I like to follow. The other thing is it's nice to have a stock trade weekly options. Weekly certainly open up many more trading opportunities rather than wait for expiration once a month. You're able to trade options that expire every week. Weeklies usually now are issued 5 or 6 weeks in advance. So if you look at most stocks that trade appreciable volume, you're looking at weekly options that are trading a month to a month and a half out. So giving you lots of opportunities, a lot of ways to fine-tune your trade in terms of time to expiration. The other thing that I look at with option characteristics is the strike price increment, and that's basically the difference between two adjoining strikes. And I look at that distance as a percentage of the stock price. And you'll find that some stocks allow you to have many options, whereas others do not. I'm using options in the non-trading way. It gives you many more choices compared to other stocks. So here's an example of BlackBerry. You'll see that really there's only one option that I can choose from. Now BlackBerry trades in half-point increments. So you see on the right side, they're under strike, 6.5, 7, 7.5, 8. And really looking at this, there's only one option that really gives me any opportunity for trading, and that's the 7.5 strike, which has a 25% probability of finishing in the money, and it has a little premium in there, bid 10 cents, ask 12. If I go down to the 8 strike, there really isn't any premium there, and if I go up to the 7 strike, I'm already at 54% probability of in the money. So really the only option that I can look at is the 7.5 strike. So I'm pretty limited in my choice with BlackBerry. If you look at a stock like Amazon, Amazon trades in 2.5 point or 10-point increments depending on how far they are from the actual stock price. In this example, notice that there are a number of choices where I can trade probability of in the money of less than 30 and greater than 10%. I have 1, 2, 3, 4, 5, 6 choices compared to BlackBerry. I only had 1. And those are in increments of 10 points. But the percentage of 10 divided by of Amazon stock price is far less than for the half-point increment compared to BlackBerry stock price. So I'm looking for increments that give me plenty of opportunities, plenty of choices with which to select my trade. Again, this is another way to fine-tune your trade. This is part of the art of trading credit spreads. Now, the next thing I look at is implied volatility. Now, as I'm sure many of you know, volumes have been written on trading volatility. I am certainly not going to go into any depth. I'm going to keep it very basic here and just discuss how implied volatility impacts credit spreads. Implied volatility is basically the market's perception of the future volatility of that stock. It's based on current option prices, and it's derived using an option pricing model. And what it shows you is it's a forward-looking theoretical number as opposed to the other kind of volatility, historical volatility, which is a statistical calculation of past price behavior. So implied volatility is forward-looking and theoretical. Now, as a component of option prices, the higher the volatility, generally the higher the option premium. Higher premium means higher credit for us as net sellers of premium. And when you're dealing with out-of-the-money options, higher volatility, higher premium means more time value. That means more time decay, more time value to decay, and that benefits us as a credit spread trader. So that's a very simple explanation of why we like higher volatility. Now, in looking at implied volatilities of stocks, you can make a comparison of the implied volatilities between stocks, but that's not really the way you want to do it, because that can be a very deceiving measure of implied volatility and in choosing which stock you want to use for your spreads. I prefer to look at the implied volatility percentiles, and what that tells you is where the current implied volatility stands compared to the range of daily readings of implieds over the past year. So where does the current reading fit within the range of readings of the past year? So for instance, if your implied volatility percentile is 60%, what that's telling you is that the current IV reading is higher than 60% of the past year's readings. So implied volatility is somewhat elevated, which means option premium should be somewhat elevated too. Generally speaking, I'm looking for IV percentiles above 50%. Now, in comparing stock implieds, let's say you have two stocks, both with implied volatilities of 30%. That's implied volatilities, not their percentiles. Just their raw implied volatilities are 30%, but the percentile for stock A is 20%. So that means that it's in the bottom fifth of the range of volatilities of the past year, whereas the B percentile is 60%. So its current implied volatility is higher than 60% of all daily readings of the past year. So that implies that the options for stock B are more richly priced. And with a higher than normal implied volatility, that means that we want to look at those as an option seller. We'd probably, if we were buying premium, we'd probably look at stock A compared to stock B. And the reason that we like to buy or sell implied volatility on the high end is that implied volatility is usually cyclical, and it tends to revert to the mean. So if it's high, the probability is that it's going to decrease more than increase looking forward. So if it decreases, that means the price of the option will decrease as well. And if we are forced to buy the option back, we can buy it back at a lower price than if implieds went up. So when the IV percentile is greater than 50%, it may be a good time to sell premium and take advantage of that reversion to the mean. Take advantage of that potential decline in implied volatility towards 50%. Where can you find IV data? Well, there are a number of places. First of all, your broker platform is a good place to start. There are websites. Doe.com is one. iVolatility.com is another. I have a screenshot here of iVolatility. They actually have a number of paid services, but this is a free service, free data that they provide every day. And this gives you the top and bottom stocks within the range of IV readings for the past year. So, for instance, LinkedIn, you can see that the implied volatility is around 77%, and that's the highest reading of the past year because the range for the past year was 77 to about 21.5. Well, it's sitting right at the top. Today's reading is the highest of the past year, so its percentile would be 100%. Compare that to the next one, which is Peabody. Notice that its implied volatility is 402%, but the highest reading of the past year has been 434, so it's not quite at the top, but it's in the 91st percentile. So that's how you would read that chart. You're looking for those stocks that have high percentile rankings. And that's something we'll be looking at tomorrow. I'll show you some data tomorrow that we can go through to find stocks to trade. Now let's move to stock direction. Keep in mind that credit spreads do have a directional bias. We're either neutral to bullish or neutral to bearish, and neutral is a bias as well. So we actually like neutral. Neutral is good because if the stock's not going to move, that means our options will remain out of the money. Our directional bias is not nearly as strong as it is when buying premium or with certain other spread strategies such as debit spreads. Keep in mind that the goal when looking and analyzing stock direction is we want the sold option to expire out of the money and worthless. We're not looking for the stock to zoom to some level or plunge to some level such that our purchased option will return us a profit. That's not the goal here with credit spreads. I'll look at charts quite a bit when looking up stock direction, moving averages, whether they're uptrending or downtrending. I look at support and resistance levels, double bottoms, double tops, channel lines, all sorts of things you can look for support and resistance levels. And the important thing to look at when you're doing this is that you are playing defense. You're not playing offense. You're basically trying to prevent the stock from moving against you enough so that your sold option is in the money. You are not looking to play offense and go for the big hit and have the stock take off from today or plunge from today if you're buying a put. You're more on the defensive than you are on offense. So you want to have areas of support and resistance that are between the current stock price and the strike price of the sold option. So if you think back to that Yahoo example, the stock was at $29.50. There was a moving average, a descending moving average that could have provided resistance at around the 32 level, and I sold a 33. So that moving average was between the stock price and my strike price. So in other words, I want to set it up so that the stock has to move through an area of support or resistance to get to my sold strike price. Again, I'm trying to play defense and not offense. Now, everybody has their methods for determining stock direction. There's probably as many ways of going about that as there are people trading. So my advice is to use what works for you. I'm assuming that most of you are experienced traders, have traded stocks for quite some time, and have your way of looking at stocks and how they work. My only advice is to avoid analysis paralysis. If you use too many indicators, what happens is they usually cancel each other out. Just stick with 2, 3, or 4, or some low number like that work for you and that you've been successful with. I'd also advise using stocks that you know their products, you know their markets, you know their leadership, you know their competitors, you know how that stock behaves, you know how it behaves around earnings, you know how it behaves before earnings, after earnings, you know what happens during product rollouts. You have a pretty good sense of where that stock is headed because, again, what you want to do is avoid some nasty surprise. You don't really care if the stock moves in your direction. You just don't want the stock to move a lot against you. So relying on stocks that you know is one way of doing that. And I try to have a bullpen of about 15 to 20 main stocks that I trade for credit spread. So I like to limit my list to 15 to 20 because that's a list that I can manage. Your list may be smaller. It may be larger. You may be comfortable with 40 stocks. And if you are, that's great. But I find that 15 to 20 is a nice number for me that I can be aware of what's going on with them. I know when their earnings are. I know what their charts look like. So I'm very comfortable, and I certainly know about their options and that they're good for credit spreads as well. So I try to keep my list somewhat limited to 15 to 20. I find that's a very comfortable number. Okay, so once we have our stock, we move on to the next item on our checklist, which is choosing the strike price. And the first thing you want to do is look at the sold option, because that's the key to the trade, is how far out of the money that sold option is going to be. As I said before, you want to use chart resistance and support levels and keep those levels between the stock price and your sold strike price. And you also want to keep the probability of your sold option expiring in the money less than 30%, although for me, I prefer 20%, but 30% is my high tolerance level. As far as spread width is concerned, in this case, you're now looking at the option that you're buying to determine the spread width. The wider the spread, the more credit you'll receive, but you'll also have to put up higher margin because the maximum loss will increase as well. Remember that maximum loss and margin are dependent on the width of the spread. So here I looked at Nike just to give you an idea of these components that you can manipulate to fit with your particular trading style. So these are actual numbers from Nike from a month or two ago. And I was looking at, these are puts and two trades, trade A, trade B. Trade A had a half point spread. It was the 61.5 and the 61 puts. Trade B also traded the 61.5, sold the 61.5, and bought the 60.5. So these were 1/2 width and 1 point widths. The credit we received on trade A is $15, and the credit for trade B was 22. So chalk that up as a win for trade B. The return, however, for trade A was much higher than the return for trade B, even though that credit was higher, and that's because trade B required much more margin. Notice that the margin more than doubled, whereas the credit did not. So the margin went from $35 to $78, resulting in a return of 28%. The margin for trade A was 43%. That's 15 divided by 35. The other thing to look at is the probability of maximum loss, or the probability of that purchased option finishing in the money. For trade A, that probability was 27%, so there was a 27% chance that the 61 would finish in the money, the 61 strike. And for trade B, the probability only dropped a little bit down to 25%, because it was a little bit further out of the money, but the probability didn't really move that much. Nevertheless, it was lower, so that's an advantage for trade B. So you can see that the numbers change depending on the width. Now, you may be more comfortable with more credit. You may like that fact that you're getting more credit, but you're also going to have to put up more margin. So you may not be able to trade as many spreads. So you have to do a calculation to see how many spreads you can trade, or how many spreads you're going to trade, what the margin is, what the credit is, how far out of the money it is, what the probability of success is. Now note that the probability of maximum success for these trades is the same because the sold option is the same. So the maximum success is that 61.5 put remaining out of the money. So that is the same for the two trades. The difference is the purchased options, the 61 or the 60.5. So a lot of things that you need to look at. As far as time to expiration, the longer the time period, the more credit you'll receive because there's more time value in that option, but there will be a higher probability of that option finishing in the money. That's because you're giving that stock more time to move against you. So as I said before, you want to balance that sweet spot of time decay and time value, and that's usually around 2 to 8 weeks, which is 14 to 56 days. So in the example I have down here, it has 25 days to expiration. And you want to balance how far out of the money you are with the time to expiration and still stay below that 30% in the money level, or whatever level you choose for staying out of the money. So in this case, we'd have to drop down to the 60 strike in order to stay below 30%. with an option expiring in 25 days. Now, the thing about timed expiration is that weeklies will allow you to more finely tune your trade because you have more choices to choose from. You have more opportunities to trade every week rather than waiting for those monthly expirations. So weeklies really are a benefit to that time to expiration, so you can really cater the trade to your expectations for the underlying. Maybe you want to avoid earnings. So in some cases, the only way to trade monthlies is to go way back to avoid earnings, but weeklies allow you to trade right up to the Friday before the week of earnings. Monthlies don't necessarily allow you to do that. So that's one of the benefits of weeklies in terms of time to expiration. Next up is position size. This is a critical component of any type of trading, and it's one that's not talked about too much, but I wanted to bring it up here. There are many studies that show that smaller trading size is better in the long run than larger trades. So a bunch of smaller trades will benefit you more than just a few larger trades. What I like to do for my positions is I don't want to go above 5% of my portfolio value for any one trade, and that's based on the margin amount. So I take the margin that's required for that trade divided by my portfolio size, and I want to keep that under 5%. So I'll trade the number of contracts that will keep my total margin at 5% or less of my overall portfolio. So if I have a portfolio of $20,000, 5% of that is $1,000. I want to keep my margin below $1,000. And finally, we'll look at trading costs. Now, trading costs can be a significant percentage of the credit that you receive. I used the example before of the Yahoo trade. We traded 10 contracts or 10 spread pairs or 20 contracts, and we received $140 in credit. Now, if you look at, say, TD Ameritrade, that trade probably would cost you around $25 at their base rate. So 25 divided by 140 is a pretty significant chunk. Now, if you have to get out of that trade by buying the spread back, you're now up to a $50 total fee on your commission costs, and $50 divided by 140, you've lost a really significant portion of your credit. So that's something that you want to be mindful of, is your trading costs. Now, what can you do to keep your trading cost in check? Well, trading more spreads will generally lower the cost per spread, and that's based on the fact that most or many option platforms or brokers charge you a base fee and then a per contract fee on top of that. So as long as there's a fixed cost, the more spreads you trade, the lower your cost per spread will be. Another thing you can do is widen the spread to increase the credit. Now that will increase the margin as well, and by increasing the margin, if you stick with that 5% rule on your position size, you can trade. You're not going to be able to trade as many contracts. So if you have a higher margin, the number of contracts is going to go down. So widening the spread gives you more credit, and it will lower your trading costs because you're trading fewer contract pairs. You can also move the spread closer to the underlying price. That will increase the credit. So the percentage of your trading fee divided by the credit is lower because the credit is larger. Of course, that incurs more risk because you are moving your sold option closer to the money. So there's a greater probability that that option will finish in the money, which is something obviously we want to avoid. But it is something you can do to lower commission costs as a percentage of the credit that you receive. And finally, the last thing is something that I've talked to a lot of people about. A lot of people have done this, and there's quite a few of you out there who have not, but you are perfectly allowed and perfectly within your rights to try to negotiate lower rates with your broker. If you've been with your broker for quite a while and you've been giving them a lot of money, it's not a bad idea to call up your representative and see if you can get a lower rate. Most people that I have talked to who have done this have been successful. I can't think of anybody who has not been successful other than a case with just starting out with a broker. You're not going to start out with a broker and then immediately give them a call and say, hey, I want cheaper rates. They want to make sure that you're a trader, that you're an active trader, that you're making money with them, and they don't want to lose your business. So negotiate lower rates if you can. If you've not done it and you're a frequent trader, you've been with a broker for a long time, I think if you take one thing away from this evening, give your broker a call tomorrow. Try to get a lower rate. I wanted to wrap up the talk today. Let me check the time. Oh, good. We're okay. With trade management, and this is an area that people ask me about a lot. I actually changed the presentation a little bit to include a little more material in here, so this is something that I wanted to spend a few minutes on to end the presentation. As far as trade management is concerned, the best case scenario and also the most frequent scenario, if you put the trade on properly, is that your sold option will expire worthless and you keep the entire credit and you have no commission to exit the trade, and that's what happened with that Nike trade from before, the Yahoo trade from before. That's the best case scenario. So that's the easy part of trade management. And one thing you'll often hear is that there are some folks out there who do credit spread training that will tell you to take profits off the table. And one of the rules that they have that you'll see is booking 50% of your credit. So what that means is if you have a credit and you can buy the spread back for half of that credit, in other words, you're keeping 50% of the credit, that's a good move to make. That if you can get a trade and close it out for half of what you received up front, that this is something that you should do all the time. I don't happen to believe in that. I don't think that that's a smart strategy. It's certainly not a smart strategy to do without question. I like to look at each trade individually, but generally speaking, taking 50% of the credit on a trade, I don't feel is a good way to have overall success in the long run. You're leaving money on the table. You're lowering your return. Worse than that, you're incurring another round of commission costs. So you're adding another burden to your commission. So really, you're not booking 50% of the credit. You're leaving 50% on the table and incurring another commission cost. So really, your net return is going to be less than 50% of the initial, less than half of that initial return. The other thing about 50% is if, in fact, you can buy the spread back for half of what you received up front, that probably means that the stock has moved in your direction. You were probably correct about the underlying stock. If it was flat, time decay, it's going to take a while for time decay to eat away at half the profit. So if the stock is moving in your direction, and even if it's flat, that means that the probability of that sold option finishing in the money has probably also declined, which means that the risk of your trade losing value has also declined. So when you look at a trade as possibly buying back a trade, look at that probability of the sold option finishing in the money number. That number may be quite low, may drop down to 15%, maybe 10%. That means that the probability of that trade reversing against you in a short period of time is pretty remote. So I like to look at the probability of in the money to help me with that decision. And generally speaking, if it's gone down, I really don't want to close the trade out because I want to capture all of that profit. So I don't generally recommend closing at 50%, but are there times to close early? Well, let's say you get 70% or 80%. Should you be closing early at 70 or 80%? Well, that might be a good move, but it all depends. It all depends on how much time there is left in the trade. It all depends on what trading costs are going to be and what your net gain is going to be after trading costs. You need to consider, as I said before, the reduced probability of your sold option expiring in the money. And is it worth it giving up the profit and paying more fees? It may be, and it may not. I don't have a hard and fast rule for that. That's something you're going to have to give a feel for, but just outright saying if a trade hits the 50% level, you should close it, I think is a bad strategy. Now, one time you may want to lock in early is if the stock moves quickly in your direction right out of the gate. So if that happens, you may be able to buy the spread back for 10% rather than 50%, maybe 20%. And it might be worth it at that point. It might be worth spending the commission fee to close the trade out and not have to worry about it, lock in your gain, because the extra credit that you will gain leaving the trade open until expiration is very small. And is it worth it to leave the trade open? Say you have a 3-week trade and in the first 2 days you can buy back the spread for 20%. Well, you may want to consider taking that 80% credit, paying the extra commission, and closing the trade. Locking it in, you're guaranteed a nice profit. I think 50% is too low. 80%, 75%, it's all what you're comfortable with. Again, this is part of the art of trading spreads. This is part of getting a feel for how your risk tolerance and how your trading style works with credit spreads. So this is something you need to get a feel for, but don't necessarily follow some, 70% I always lock in, 80% I always lock in, 50% I always lock in. I think you need to look at these on a case-by-case basis. Now, let's look at the other end, closing at a loss. The one thing that you want to avoid with credit spreads is the big loser, the 100% loser or the 80, 90% loser. I can't tell you how many times people have come up to me when I've talked about credit spreads and said, hey, yeah, I really like credit spreads and I like the concept and it's, I like the fact that you win a high percentage and, and it's income and everything. But boy, man, just that one trade will just kill you. That one trade will just wipe out, so many winners, and I just can't deal with that. Well, you don't have to deal with it. If a trade is going against you, you get out, and you don't let 100% losses occur. So if an option expires, if the purchased option expires in the money and you get 100% loss, yes, absolutely. That trade will probably wipe out several winning trades. If your average win per trade is 15% and you have a 100% loser, you've just wiped out nearly 7 winning trades. We really can't afford to do that. So you need to avoid the 100% loss. So the question is when to act. And again, this brings up another part of this art of the spread, getting used to spreads, getting used to your trading style. Keep in mind that the overall goal in trading spreads is to maintain portfolio profit, and that is based on the percentage of trades that you win or the win rate, the average size of your win, the average size of your loss, and you have to include your trading costs. Once you know those things, you can calculate whether you are going to be successful over the long run. So if you have an 80% win rate, so you win 4 out of 5 of your trades, and you average 20% on your win and 50% on your loss, your average win per trade is going to be 6%. If you have an 80% win rate and you're 15% win, 40% loss, your average drops to 4% per trade. So these are the kind of calculations that you need to do to answer the question of when to act. I think a good guideline for people who are just starting out with credit spreads and who don't really have a feel for how the strategy works and also how their trading is progressing. In other words, they don't have a good sense of their win rate yet. They don't have a good sense of their average win size, their average loss size, is to keep the average loss to no more than twice the average win. So if you're averaging 15% on your wins, then you try to limit your losses to 30%. So the amount of the loss is twice the size of the credit that you received. So if you were able to do that and you win 4 out of 5 of your trades, if you have a 15% win percentage, average win rate, average win percentage, and a 30% loss percentage average, that equates to a 6% gain per trade. If you bump that up to a 20% win and a 40% loss, again, the loss is twice the size of the win, that equates to an 8% return per trade. Then you have to look at your income goals and see how much do I want to make each month. If I'm making 8% per trade and I want to make X dollars per month, how many times do I have to trade to make that income goal based on my current account size? See, there's all these things coming into play here. So I'm giving you a guideline, but this is something just to start out with. I think you need to feel the strategy and get a sense of where your trading is taking you, and that way you can decide on when to act in terms of cutting off losses. Now, I will say that even forgetting all of that, you still need to avoid those big losses. So whatever the loss limit is in your trading, stick with it and avoid those big losses, because these people are absolutely right. That'll kill you. And if you allow that to happen, you won't be trading credit spreads for very long. Now, once you establish that point of when to do something, the question is, what do you do? Well, for people just starting out, I want to keep it simple once again. So we have a simple rule of when to close out, and we're going to have a simple rule for how to close out. And I don't want to complicate things. There are many, many, many ways that people can adjust and play with credit spreads. I have seen more different strategies, whether it's adding another credit spread, rolling the credit spread out, buying a put, buying a call, selling a put, selling a call, turning the spread into a butterfly, buying stock, selling stock. There's all these things that you can do to adjust or reformat your credit spread. The problem with those things is most of the time they're basically taking away the essence of the spread, which was an instrument that is all you want to do is keep it out of the money. And it's a very simple strategy if you think about the basics. And all these adjustments and things just complicate it. Now, some of them have merit, and that's fine. But they're not for a discussion for people just starting out with a strategy. So to start things out, what you do is you simply close the trade out. You just buy it back. So if the loss reaches twice the credit, close the trade. Don't buy stock. Don't buy any options. Buy the spread back. Don't roll it out. Just accept that you were wrong, accept the loss, move on to the next trade. Keep that loss manageable, and that will allow you to maintain your overall profitability. So that is the presentation. Wow, I kept it to 90 minutes. That's pretty good. I'm happy with that. Just to wrap up what we went over a lot of material. The credit spread basics. So we talked about the what's, the hows, and the whys, and the wherefores of credit spreads. We looked at a couple of examples using Nike and Yahoo. We talked about some factors to consider when trading. Looked at the advantages of credit spreads as well. Went through a pretty long checklist to get ready for your trading, all the factors that you need to consider to put on a trade, and then finish it off with trade management. So an awful lot of things to mull over and to think about. I know I've thrown a lot of material at you, but that's okay. You can handle it. And again, as Dave said, this is available. You can certainly refer back to it. You can get a copy of the slide presentation and also the audio. So with that, I believe we are ready for Dave to come back in and moderate.
Thank you, John. Good session, good presentation, and I really enjoyed that. I'd like to hear that every time. I'd like to go through that. We do have questions that have been coming in, so I'm going to try to get back to all of them, and certainly you can use the question box to add questions to those. We've also had some comments that a couple of them very interesting. Go ahead, John.
One request. Can we take like a minute break?
Yes, you can take a minute break here. I will fill people in on what happens to this.
Okay.
The rest of the time. Again,
you can listen to Dave, and I'll be back in a minute.
Yes, I will take 30 seconds
Thanks.
basically to tell everybody that this session, again, has been recorded. If you haven't known that or come in late to the session, it is being recorded and we posted up on the site. The website I actually put into the chat box, so you can go there. You should have been sent an email on how to access the website and enter a password for that. That recording will be up there later tonight, probably overnight, actually be there first thing in the morning when you wake up if you're on the East Coast or the Midwest. And then the slides from this presentation also will be posted up there, so you can take those and go through those slides as well. On that website also will be the recordings for tomorrow's session and Friday's session. We get back together again at noon tomorrow. John's going to take you through anywhere from 1 to 3 trades, maybe more. He's going to look at a number of different setups and then try to get trades on for tomorrow, so you can not only see how John puts those trades on and constructs them, but you can actually make the trades yourself right there and follow those through. We will then get back again Friday at 3 p.m. Okay, Friday at 3 p.m., and that's when we'll do our 30-minute trading session where John will look for trades in the last hour Friday before the expiration. Okay, John, if you're ready, I just took him through the next couple of days, but let's get to the first questions here. I think you actually already answered this one, but again, about the finding the IV in relation to the past year, had a couple of people asking about that. I guess that was your 3 different sources you had mentioned there.
Yeah. Right. Yeah, there's a number of places to look for that. The broker platforms, I know Thinkorswim will have it. I think you actually have to ask for it, but you can just call them up and say, I want to get the IV percentile, the IV rank, and they'll send it to you, or they'll add it to your platform. Doe.com, iVolatility. iVolatility is a great site. I'm not affiliated with them in any way. They do have a lot of free material on there. They also have paid services, but they do give you daily little teaser data, which I find quite useful. So they're like the go-to for volatility questions.
Okay. Tina has a good question here. How do you feel about lower-end stocks? I guess she means lower-price stocks versus stocks like Apple, which may be too rich for beginner's blood.
Well, the price of the stock doesn't matter as much as the price of the options. I mean, it doesn't really matter what the price of the stock is as much as the options that you're looking at. So in terms of lower price stocks or higher price stocks, I mean, I've traded Priceline, which is a 4-digit $1,300 last I looked stock, and I've traded single-digit stocks as well. It all depends on the volatilities and what the prices are of the options. So that's one of the beauties of spread trading, is you're not really knocking any particular stock out just because it's lower price. Now, yes, in general, higher price stocks are going to give you more opportunities to trade because of that strike price increment that I talked about. When you're looking at a BlackBerry, it's just going to be tough to find. You're going to be limited basically to one strike price that you can trade. That's going to be below that 30% threshold, and also give you enough premium to make the trade worthwhile. So in terms of Apple is certainly not too rich to do credit spreads on. Again, you're just looking at one of the beauties here is keep in mind that you're buying and selling premium. So there really isn't, if a stock has really high priced options, keep in mind that you're selling premium and buying premium, so it keeps that margin amount manageable. So there really is no limit to the kind of stocks you can trade spreads on.
Okay, this is a question I'm not familiar with this. John, this is from Fred. Is it true, or Robert, excuse me? Is it true that an out-of-the-money option can be exercised on a Saturday after expiration? Example: some news happens after the market closes on Friday or Saturday morning. I'm not 100% sure on that, but an out-of-the-money option being exercised, well, I don't know why that would be. Yeah, I'm
But,
not sure. I mean, if in a normal, if you're having an assignment or exercise, you're going to get the notice from your broker on over the weekend about that.
Right.
If it's
Right.
expiration Friday for your expiration date. Yeah, I know with Thinkorswim or TD Ameritrade, the notices come in late Friday night or Saturday morning, and actually, if you're taking assignment or exercise, it's going to happen on Monday morning and you get that done. But I don't know about any. If you've expired in the money, certainly. Anyway, that's a new one.
Well, then absolutely.
Yeah, absolutely. But I don't think it can happen after. I mean, it's just when you get the notice from your broker. Well, I will say when you're selling one-sided options, puts or calls, you can be exercised at any time with American options. I mean, if somebody wants to, the price on a stock drops so fast, you can be assigned early. That is definitely true. Let's see here. Adjustments. I know you mentioned that briefly. Just another. Is there a time to make adjustments? Or of course, you were advocating tonight. Really, you'd rather just close the trade than make adjustments. But is there a time that you would look to make adjustments if you're going to make them?
Well, to me, it all depends on where the return is sitting. If you're down in that, I'm not going to make any adjustments if the trade is doing fine. I'm going to let it ride. So to me, that's the maximum benefit or the maximum result that you can get is just let it ride. In terms of when I talked about, if the loss reaches twice the credit, that I would just close out the trade. Adjustments, people usually don't do adjustments unless the trade is either doing really, really well or about to really do poorly. So, some people, it may be a strict loss level. I've seen people that when the loss reaches 20%, they immediately do an adjustment by buying stock or selling stock. I mean, there's all sorts of crazy things that people do. But basically, at that point, you've taken away the essence of the trade. And you've turned it into more of a repair than a strategy that is basically neutral to bullish or neutral to bearish. You've turned it into more of a directional strategy, and you're doing repairs on it. To me, I would just rather close it out.
Okay. Question here, Jim, about trading costs. I guess actually you did mention trading costs. Clearly, you spent some time on that. But when you do your calculations, you are including trading costs, and tomorrow you'll cover that a little bit too, I think, in the trading session, John. Is that true?
Yeah.
Giving people, I mean, I think you always want to look at what your net credit is after trading costs because they are real.
Right. Absolutely. Especially with credit spreads, you can really drop that credit. Like the example I gave you, if you're spending $50 out of 140, I don't know what's that, 30%, more than 30%, like a third, about 30% of your cost is in trading fees. So you really have to be mindful of trading fees when you're doing this. And call your broker, negotiate.
Right. Julian asked here, do you use any specific methods to scan for stocks and to trade credit spreads on, volatility level scans? I think that's the question.
Well, yeah, I'm looking. I have a couple of things that I look at. We'll show those tomorrow on a couple of those sites where I'm looking for higher implied volatility percentiles, those ones that are above 50%. So that's one thing that I'm looking for. Obviously, I'm looking for stocks that have the right kind of options. I'm looking for stocks that have weeklies. Once you start going through this, the list of stocks that you concentrate or spend most of your time on will become fairly apparent. It has with me. There are some stocks that most of the stocks I just don't care about. I have the ones that I'm comfortable with, and those are the ones that I'm looking at. Now, there will be times where, I may check out a stock here and there, especially if a stock pops up on some of these volatility scans that I'd never heard of. I'll take a look at it, but that's usually the place that I'll start is the volatility.
Okay, here's interesting. Just a comment. Gerardo has. I'm not familiar with this, but I guess for smaller accounts, another great thing about credit spreads on a small account, $5,000 to $10,000, is you're only allowed 3 trades per week. But if you hold it longer than a day, it does not count against your 3-day trade week allowed, so you can do more credit spreads. I don't know if you're familiar with that, and that may be some brokers do that, some don't.
That may be with a particular broker. I've not heard of that. But I would generally, if you're starting to trade credit spreads, I'd call up your broker and just say, hey, look, I want to open a credit spread, or I want to start trading credit spreads. Do you have any special rules with that? I understand margin. I understand that it's a necessary part. What are the fees associated with it? I would call up your broker and just make sure that you are familiar with how they treat credit spreads and what features and benefits they offer that allow you to trade credit spreads. So I have not heard of this 3 trade per week rule, although generally 3 trades a week I won't. That's a lot of trading, but for some people it's not.
He's experiencing this with
but I would ask that ahead of time.
Yeah, he's thinking that with he's experiencing that with Thinkorswim. So probably for a small account that may be the case.
Huh.
I'm not familiar with that on that size account, but that's with Thinkorswim. Another question related.
Well, it just underscores, Dave. It just underscores that you need to talk to your broker and just make sure that you understand whatever rules that they have that pertain to credit spreads, and that may go beyond credit spreads. That may be any option trading. I don't, they may have rules like that.
Okay. This is similar. I think the question here though may be contract size or contract volume. I find that let's see. Tina finds the premium paid, or the premium she receives, versus the price to buy is so small after the broker's fee. Any suggestions? And sounds like you need to get the right spread, but go ahead and address that question.
Well, it can be. Again, this is why you need to look at how many spreads you're going to trade. You need to look at the width of the spread. Sometimes the credit you'll look at credits that are way out of the money. A couple 3 cents, 5 cents. You can't do that. That's just not going to be worth your while. So you need to, depending on how many contracts you're going to trade, you need to figure out what percentage of your credit you want to give up to your broker. Generally, I'm looking at, I don't like to go above 15, maybe 20%. That's a lot of fee that I'm giving to the broker. And certainly this is a different world than with, just buying straight puts and calls or buying stock. I mean, if you're buying 5,000 shares of stock and you're paying $10, and that's a drop in the bucket. That's nothing. But with credit spreads, it's a considerable amount. So that, which again underscores why having these things expire out of the money is important, and also underscores why you want to be really careful when you buy back a spread. Just don't buy 50%, because you're not going to get 50% after you take out your trading fees.
John, Stuart asked, do you ever use indexes or ETFs to do credit spreads?
You can. Generally, the volatility on those is not as high. Now, having said that, there was one that popped up on the volatility screen. It was a Direxon 3X, gold bear something or other. I can't even remember what it was. And I looked at the options, and there was actually quite a bit of volume on the options, but that thing scared the hell out of me because I didn't know it. I just didn't know anything about it, so I stayed away. But generally speaking, the credit that you'll receive won't be as good with ETFs because of the volatility. Now, if you're looking at trading longer-term spreads and you have a pretty good idea of the market and there's a nice resistance level or support level, ETFs or indexes can be good vehicles for that. But generally, the type of trading I do, I'm looking at equities just because of the volatility.
Good. Julian has a good question here. This goes. I know you addressed spread width in the presentation. Do you look for a particular spread width, or does that differ per credit trade? For example, trading 90-95 on Apple versus 90-100, which would you be doing, and why?
Well, as with many things with credit spreads, it depends. 10-point spreads, that's pretty wide. Generally, I won't do 10-point spreads because the hedge is almost worthless at that point. Your risk is also quite large with those kind of spreads, and the extra benefit that you get from widening out that far is generally not worth the amount of maximum risk that you're undertaking. So with 10-point spreads, you're also not going to probably be able to trade many contracts. That's a good way to keep your trading fees down, but you're not going to get the extra credit. You're not going to get the bang for the buck, I don't think, for the extra credit. Generally, the first thing I'll look at is whatever the increment is. So if it's a half point, if it's 1 point, 2.5 points, I'll look at that first and see what kind of return I'm getting. I'll look and see how many contracts I can trade. I'll look and see what my cost, my commission cost is as a percentage of the credit that I'm receiving, and then I'll widen it out to the next increment and see what those numbers look like. And sometimes the comparison will give you a pretty obvious answer as to which one you should go for. I also look at the probability of the purchased option finishing in the money, which defines my probability of maximum loss. So I'll incorporate that into the equation as well. Again, this goes back to the art, where you have a lot of things to look at. But I would generally stay away from the 10-point spreads because I just don't think they're going to give you the bang for the buck. I mean, you can look at them and you can see what the return is, but I think generally the returns are going to be pretty low because that margin, that denominator in your return equation is going to be awful high.
Yeah, it's good. I think one of the things, too, you can do with these, obviously now most online broker screens, you can actually do some looking at spread widths without having to trade them, obviously, and see what the credit is. I mean, it's very nice and easy to use the broker screen to help you sort of analyze that. And I think that's actually an important thing. And John, you might mention something you've mentioned to me a lot for people, particularly new and particularly maybe even the first time, although certainly is paper trading some of these just to get a feel as well. I know you're a big proponent on.
Oh, absolutely, absolutely. I think that along with that call to your broker to tell them that you want to trade credit spreads and is there anything special they need to be aware of, and make sure you know what the costs are and whatnot is definitely open up a paper trading account to just try the strategy out, practice getting in and out of trades. Practice seeing how trades behave. Practice looking once you have a trade on what it would cost to buy it back. There's all sorts of things that you can just practice on. Go different widths. Look at what happens to the credit at different widths. Look what happens to the credit if you go out another week, another 2 weeks, another month. Play with all of the components of the trade just to get a sense of how that credit will work, and also look at the cost of putting on those trades and look at the return of the trades. Again, there are a lot of factors that you have to consider, so I think the more you can practice and get used to it, the better it'll be when you're putting live money on the line.
Okay. Tina has a question. Do you determine what percentage or amount you want from a spread, i.e. premium income to cost? You use Nike as your example, 61-50, 60, and then 61-50, 60-50. Of those shown, which did you prefer and why, or at least for you?
I actually, in that example, I think I preferred the narrower spread, because of if you look at if you put up an equal amount of margin in the two trades, which means you'd have to trade more contracts of the narrower width because there's less margin. I think the return that you get, the credit that you get for that equal or near equal amount of margin is better for trade A, which was the narrower width than B. So I would generally prefer A, even though you have to count in trading costs too, because you're trading more spread. So that's why it's nice to have spreadsheets, which is something we're actually working on right now, is putting together some calculators that'll make that whole process a lot easier.
And this,
or I'm in the process of coming up with calculators.
Right. Now, I think this is good because Tina maybe have the last good question here of the night. I see. I'm somewhat like Tina here. She says, "When do you sit down to do your calculations the most? Tuesday morning or the night after the close?" She says, "I get frustrated calculating while the market is jumping around." I can relate to that, Tina.
Yeah. So what's the question? When do
you do your calculations? When you
calculate where a trade is at, or
no, when you're looking to set up a trade, when you're thinking about trade setups, are you doing it the morning of? Or are you doing it the night before? When do you do your calculations? Kind of see what trip.
Well, no, I mean you really can't. Yeah, you really can't do it the night before. Because, I mean, you can get an idea of where a trade is at, but once the market opens, then it's it could blow it all to hell. So I generally will I'll do my calculations right before. But I'll do, like for tomorrow, I'm going to have some trade setups that I'll be working on tonight and tomorrow morning, and hopefully they won't get messed up by the morning's trading. But I'll have a decent idea of what I want to talk about tomorrow based on work that I'm doing tonight and early tomorrow.
Yeah, I think that's.
You generally, in terms of calculations, I don't think you. Pardon?
Yeah, I agree. I think you do some of your advanced research ahead of time, and but you never know when the market opens.
Right.
What's going to happen there?
No, you may have a couple of strikes in mind. You say, "Ooh, that looks like a nice trade," and then the next day those strikes will be gone. You may have to move up or down on your strikes, or you may have to widen it out too.
So, I guess your last question or follow-up is: so tonight, you looking at your IV numbers to get an idea of what to trade tomorrow?
That'll be one thing. Yep, absolutely.
Okay, good. Well, that is all
bet.
Questions for tonight. We'll obviously take questions again tomorrow during the trading session. John, if you want to wrap up, and then we can get together with everybody tomorrow morning, or everybody at noon tomorrow. Excuse me.
Well, just to reiterate that tomorrow, noon Eastern time, we're going to go through some live trades. I'm going to go through quickly through my trading checklist, and then I'll have some setups ready, and then we'll take a look and see where those trades are. And then on Friday, we'll do a quick review of those trades that we do on tomorrow on Wednesday, and also hopefully add a short-term trade.
Good.
But I think that's about it.
Okay. Well, thank you, everybody. Been a good session. We will send an email out on when the webinar is, or the webinar tomorrow. Get you into it and make sure you're there. As John said, he'll be going through the checklist and setups the first part of that, but we'll probably be trading by about 12 or 12:15. So if you're a few minutes late, you'll be able to get in the trades, and we'll post them up on the website too as well. We thank you for attending tonight. This session has been recorded and will be posted up in the morning for you to access. We look forward to seeing everybody tomorrow at noon for live trading. Thank you, everybody.
Thanks a lot.
Good evening.
See you tomorrow.